couple of things before we get started. Um, One of the things that the IRS points out is that people who prepare their own returns, 74% in 2017, which is the latest data, overpaid their taxes. And that's from the IRS itself. So I guess that's my commercial. Okay, so end of commercial. One of the most overlooked deductions is that people don't realize that, previously we could deduct interest on credit cards. Well, we can't do that now for personal, but we can for business. And it's one of the most overlooked deductions that are, this is the number one overlooked deduction. So I really encourage everybody to keep track of the interest on their credit card. And it's amazing how quickly it adds up, and make sure that you deduct that. The other thing that most people don't realize is that every single return is audited. Now, I know a lot of people prepare taxes and they think, well, I'm too small, it's not going to be looked at, I'm not going to be audited or anything like that. But every single return that's filed goes through what the IRS calls scoring, and it's an electronic audit. And if you fall outside of their parameters, and their algorithms are most closely guarded secret in the entire United States. I think it's probably more closely guarded than the nuclear launch codes. Right? But that being said, if you fall outside that, then you're going to have somebody with eyes and a brain look at it and say, that's right or it's not right. So for example, I had a chiropractor a couple of years ago that had a large deduction for mileage, business mileage. Well, you don't normally think of a chiropractor using their car. And so his return got kicked out, even though it was less than $100,000 income. He got audited. It turned out that he did have a legitimate reason because he combined, which he shouldn't have, but he combined both his MLM business and his chiropractic business. So for the MLM, he had a lot of miles, but that's the type of thing that the IRS looks at. And so the point I'm trying to make is be conservative when you're preparing your return. You want to take every single lawful deduction that you can. I hate my clients paying even $1 more in taxes than they have to, but there's a definite line. And if you want to cross that line, I'm not going to do it for you. Okay. I mean, I'm going to save you every dollar I can, but I'm going to keep you and me out of jail. So don't, like I say, don't get complacent because you don't think you make $1 million a year. So that's one of the things that I think's possible. The other thing I just wanted to bring up real quick, and I'll get to the questions, Lisa. I know that that's a big part here, but I want to talk about write-offs and how they really work. And oftentimes I hear, but it's a write-off, Well, if you have a legitimate business expense, and the IRS defines it as ordinary and necessary, okay? And you have to spend it for your business, and yeah, it's great that you write it off. But if you have an expense that is elective and you decide to go for it and write it off, keep in mind that for every dollar that goes out of your pocket, the IRS may is going to refund you your tax rate, which may be 30 or 35%. So for every dollar that goes out, 65 cents is lost. So the best thing you can do is keep your expenses to a minimum. Yeah, necessary expenses, write them off. Unnecessary expenses, keep them to a minimum. And my philosophy, I'm a long-termer. I like to look at things long-term. And I just feel that if you keep your overhead low, in bad times, you survive. In good times, you make more money. So those are the things I really want to talk about. I'm sure, Lisa, that you encourage your people to have separate bank accounts and keep track of their sales tax separately and put a fund away and things like that. So, but anyway, I just want to mention that. I think those things are really important as we head into the tax season.
Thank you, Mel. And I to just reconfirm what you're saying is make sure that the items that you want to consider as business expense is really worth it, because the saving on maybe that $100 dry cleaning expense is really what is the deduction on that, right? 20 to 30%. Is it really worth it for you to do that and create a red flag on your tax return? Thank you so much, Mel. And then Mel was just starting to talk about commingling of funds, which for our client base, there's a lot of that going on. And I understand when you first start out your business, a lot of us don't even know if it's going to work out or not. And so we don't want to spend so much money trying to figure out, and a lot of the banks and credit cards don't want to give you credit anyway because you're just starting your business. So we tend to see clients who use their personal credit card for business, which is fine if you dedicate that one credit card for the business expense. So now, could you talk a little bit about how commingling of funds, meaning using the same account, whether it's a bank account or a credit card account for both business and personal, how does the IRS look at that? Why is that so bad?
That's a really good question. Obviously, the IRS what that opens up for the IRS is that they now have the ability to look at everything you do, which is not something that you want to do. If you keep it separate, then they can only look at the business bank accounts unless there is they detect fraud or something like that, which is very unusual. But it really becomes important when you have an LLC or a sub-S corporation, because the main reason to do that is for the liability protection. But if you're commingling funds, then some smart attorney can easily pierce the corporate veil and in effect know the benefit of the LLC or the sub-S corporation. So it's important in any case. It's extremely important for an LLC or a sub-S corporation.
Yeah, and that is such a good leeway into actually my next questions. And this is one of the questions that I've received from clients. But before I ask the question, I just want to remind everybody again that this session is being recorded because a lot of the clients could not make today's time. So we'll be sending them the recording later. And so when I ask these questions, for your best interest, I do not mention your name. I just bring up the question so that way we can keep things confidential for you. So we'll talk about the subchapter S and LLC. Could you give us a little bit of idea on how do you decide what type of entities to have, or should you even incorporate?
Yeah, that question I get asked every single day. And I'm going to give you the 10,000-foot view, because every situation is different. But here's some things to keep in mind. If you file and obtain an LLC or a sub-S, it's going to be more expensive for you. And the reason that you would do that is for liability protection. That's the number one reason that you file for an LLC or a sub-S. And I'm going to talk another huge benefit for a sub-S in just a second. And then I'm going to make a recommendation. But if your business, you don't incur a lot of liability, you're not subject to a lot of liability, or if you can insure around that liability for a reasonable number, then in my opinion, there's no reason to form an LLC or a sub-S if you are a sole proprietor. It costs you more. The state of California, it's going to cost you a minimum of $800 a year. For tax preparation, it's probably going to cost $500 or $600 or more, depending on what's involved in the entity. And so there's some expenses that you just don't need, and there's no real benefit. You can still do the same pension deduction and those kind of things with a sole proprietor that you can with a corporation or with an LLC. We don't ever want to consider a C corporation, in my opinion, because you're subject to double taxation. The corporation is subject to tax, and then when you take the money out, then you're subject to tax as well. So there's double taxation. So the way to get around that is a sub S corporation. And it provides the same tax liability or liability protection as the LLC. However, it's a lot more rigid in filing and equity requirements. And that means that for an LLC, if you and I go into business, then you can say, well, look, I'm going to take 90% of the profits and you only get 10. And then it can be allocated that I get 90% of the deductions and you only get 10. You can do all sorts of things like that. Plus, if the admission of a partner becomes very easy at that point. You just admit the partner. Within a sub S corporation is different. The partnership is allocated based on the equity of each individual partner. And so that is a very rigid requirement. There are other legal requirements as far as record keeping, annual meetings, records of minutes, all those kind of things. So there's some things with an LLC that there are some disadvantages. However, if you're a single person, you can't get around the liability problem and you still want some sort of liability protection, but you want to have a little more, let's say, gentle organization, then you can file and organize as an LLC, but you can elect to be taxed as a sub S, the best of both worlds. Mm-hmm. And one of the advantages of a sub S corporation is when you get to the point where your business is making more money than you need to live on, then you can stop paying yourself a salary at that level. And any other income beyond that is not taxed as payroll. So for example, let's just say $80,000 is what you make and what you need to live on. But your corporation makes $120,000. With an LLC, you have to pay payroll taxes on $120,000. With the sub S, you only have to pay it on the $80,000, the $40,000 difference, and it's about 15%. So you're saving $6,000 right there in that one example. So mm-hmm. There are advantages of the sub S that we can incorporate in the LLC without the disadvantages of all the additional record keeping and the very strict equity structure and things like that of a corporation. So my recommendation in a nutshell is sole proprietor if you can insure around the liability, LLC if you can't, and then elect the sub S tax treatment. The one other thing that I want to caution you is I advise my clients that once they have one employee, and we can talk about employees if that's a question, but the one thing, when you have employees, I recommend at that point you become an LLC. And that's because you just never know what the employee is going to do, either to harm you, your company, or your clients, okay, or to turn against you because they want a free ride. And I hate to say it that way, but unfortunately, we see it all the time. So no employees, no liability, sole proprietorship. No employees, liability, LLC, filing as electing to be filed to tax as a sub S.
Wonderful, thank you, Mel. It's so refreshing to hear your recommendation that don't incorporate if you can do if it doesn't make if all the boxes are not checked, right? Because it seems to be in recent years there's this movement of CPAs, attorney, encouraging small business to incorporate, everybody have an S Corp, everybody have an LLC. And like, do you really need it? Because to Mel's point of view, there's extra costs, additional expenses that incur for that. And if you don't follow the correct guidelines of how to operate as a corporation, that protection that you thought you have is broken. So thank you for sharing that, and your honesty is so much appreciated.
One of our participants made a comment / question, wondering that it was her consideration that an LLC taxed as an S corp paid less taxes than a sole proprietor. Can you speak to that, Mel?
Well, at some point, we're really talking here about payroll taxes. So there is an opportunity to pay less payroll taxes, yes. Okay, other than that, no. If the corporation makes 120 grand and the LLC makes 120 grand, you're still going to pay taxes on the whole 120 grand. It's where the savings comes in, Victor, is in the payroll taxes in the amount above what you need to live on.
Mm-hmm. And so that's also a question I commonly heard people ask about or not aware of, is that when you have a subchapter S corporation, that the IRS expects you to have payroll. Is that correct, Mel?
Oh, it's required. One of the officers, owners, has to be on payroll. And so even though this sounds great, let's go back to our $120,000 example. You are required, as Lisa says, to have a payroll. And the IRS has something called reasonable compensation. So they expect you to have reasonable compensation. So the advantage of not having reasonable compensation, let's just be ridiculous and say, okay, I've got a salary of 10,000 and I've got a distribution up to the income of 110,000. So I'm only paying payroll taxes on 10,000. The IRS is constantly on the lookout for that. Mm-hmm. So you need some reasonable compensation before you get to the point where you can distribute the funds without paying payroll taxes. But Victor, income taxes are the same.
Great, thank you for that. I also have a question from one of the clients that emailed me is it best practice to have your CPA file your business tax and your personal taxes?
Well, I think so. I mean, the more that the CPA knows about your particular situation, then the better job he's going to be doing as far as ferreting out all the deductions that you're entitled to. So, yeah, I definitely think it's a good thing.
Yeah, I think that the person that files your taxes needs to see a big pictures of not just your business, but also your other income, maybe your personal deductions. Exactly. And then the question is, can you simply explain carryover loss? Our business will be report a loss, and hence how can we use that to our advantage?
Yeah, that's a great question. Yeah. That changed a lot with the CARES Act. It used to be a long time ago, you could carry the loss back 5 years, okay? And then you could carry it forward until you exhausted. Then the law was changed and said, no more carrybacks. You have to carry the loss forward. Okay, that was particularly effective because the IRS was seeing all these corporations merge with another corporation that has a huge loss, and they go back and they get the refund. So the IRS caught on to that and said, no, you have to go forward with that loss. Well, the CARES Act said, hey, we know people are hurting and they're having losses, and so we're going to allow them to carry back 3 years. So what you can do is you can carry it back 3 years, file an amended return for that 3 years, and then get the refund or reduce the taxes for 3 years ago. And you can then carry it forward as long as necessary in order to absorb it. So there was a recent change, and yeah, if the loss is significant enough, it's definitely good practice to go ahead and carry it back and refile those returns.
Great, thank you. I have a question that I don't know if it would be for a business formation attorney, but I'm going to throw it out to you anyway, Mel. I always ask you any questions that I have anyway. So the client said, we moved and registered our business in a new state, and our old LLC was merged into the new LLC to retain all business items like EIN, bank accounts, etc. due to COVID. Will that affect our business return, if any?
Well, it depends. If the operation is in California, it doesn't matter where you incorporate, you're still going to pay tax as a foreign corporation in California. So, however, if you move, if you operate in a, let's say Nevada, no taxes. If you actually move and your operation is in Nevada, then yes, it definitely would be a benefit because you wouldn't have to pay the California taxes. Federal taxes, no effect. Okay. And just to give you an example, I had a client that, a famous client, everybody would know the name if I said it. And he thought he was really smart. So he bought a townhome in Las Vegas. And so that became his tax home. The state board or the franchise tax board caught up with him and said, no, I don't think that works out, because they asked him such things as, where are your pets?
Wow.
Did you join any civic organizations in Las Vegas? Those kind of things. So ultimately, he thought it was a good idea and he ended up paying for it.
Oh, so if you moved or buy a condo somewhere, just make sure you join like a BNI group locally or something.
That's right.
I know we have a few BNI members on the call right now.
Lisa, I've even heard of things where people will engage like a, what's that? UPS store in like another city, and they have an address in another state, okay, and yet they're still in California operating the same. So they just hope that they don't get that something happened before the government caught up to them, but they always will catch you. So I know we have. Go ahead. No, I was just going to say, it seems like they always catch up with them.
Yeah.
I've had people come to me and say, no, I don't really want to file a return because I haven't filed for the last 3 or 4 years. So I don't want to awaken a sleeping giant. Okay. It doesn't work that way. The statute of limitations for federal is 10 years. So if you get away with it for 10 years, you may get away with it. Although I think what would happen in that case, the IRS would claim fraud and they can go back to the day you're born. So not a good idea. Not a good idea to mess with the IRS. I
wouldn't mess with them. And it could be because I've been around with you for too much. I'm like afraid of I'm trying to do things the right way. So let me, Victor and Kendra, do you have any questions from the chat that we need to address before I move on to the next topic?
One just popped up. A participant was asking Mel, what is typically considered a reasonable compensation for officers in a subchapter S Corp during the startup years?
Yeah, that's a great question. The IRS is totally nebulous, totally silent on this. And each case is decided on its own merits. So you can't say that if the company makes 100 grand and I pay myself 50, that's reasonable or not. What my experience has been is that if you try to abuse the system, you make 120 grand and you pay yourself 10, you're going to get, or I've run into cases where they pay themselves 0 and they pay no payroll taxes. Then the IRS is going to step in and say, this isn't good, this isn't working, and you get all sorts of bad things happen. But, when you get to the average income for the entire United States, about 55,000, I think at that point you're pretty safe. Now, for a startup, if you're not making any money, you can't pay yourself anything, right? So I wouldn't worry about it at that point. It becomes an issue when you start having profits that exceed your salary.
So I want to echo that point again, is that I actually do see this, especially this year with all the stimulus money and the Paycheck Protection Program. I see companies or clients putting themselves on payroll when the business is not making any money yet. So to Mel's point, you don't need to pay yourself on payroll when the business is not making money, because when you pay yourself through payroll, you're paying payroll taxes. So there's no reason to do that until your business starts to make money.
That's an excellent point, Lisa.
Yep.
Excellent.
And so, thank you. I tried. So with I was, like I said, this year, the reason I wanted to do this tax series, because I know tax season this year is oh my God, I do not want to be a CPA this year. In fact, I'm going to put together a lot of rescue packages for CPA. You're going to need it because, you know, with the pandemic, so a lot of people are going out of business or having just weird transactions going on in their business. Not only that, the addition of the CARES Act, which, you know, have helped people, help small businesses, but it has also created so much confusion in terms of how do you write it off? Can you write these off? Do you have to pay taxes on it? So if you have some, you know, pointers on this, a general idea, just let me know, just share it with us, and then I have some specific questions for you.
Okay. Well, first of all, the EIDL grants, when you actually receive a grant, that's nothing but good news, because at that point, it is not income to you. You don't have to pay taxes. You don't even have to declare it. Okay, so if you have received an EIDL grant, also, like I have clients that have received grants from cities, like Costa Mesa has a real active grant program and things like that. As long as it's a grant, you don't have to pay taxes. The other thing too that comes up every once in a while is a research stipend. So I have a client that is a researcher at Scripps, and he received $45,000 this year on a stipend, not declarable. He doesn't have to report his income. He doesn't have to pay taxes on it. Now, as far as the PPP goes, and I'm going to get back to the deduction thing in just a second, because it's a tremendous benefit to the company. As of right now, and this could change, but as of right now, the money that you get from a PPP is not income. You don't have to pay taxes on it. However, the expenses that you pay for that are not deductible. So in effect, it's taxable. Okay. So is this a good deal? Sure, because it's just the opposite of an expense. Remember we talked about, you know, a 35% tax bracket still costs you 65. Well, in this case, it's the opposite. You have to pay 35 cents in taxes, but you've got $1 in your pocket. So if you've got, you know, a $10,000 grant and you're in the 30% tax bracket, you're better off by $7,000. So it's really a good deal, and it's helped a lot of people.
Thank you. So in a roundabout, you pay some taxes, but not as much as it would be if it was a taxable loan or forgiven grant. After it was forgiven, it's a grant, essentially taxable grant.
It has
but
to
it's
be
not.
titled for grant.
Yeah.
And there's no obligation to pay it.
So on that note, though, my clients, when I prepare your financial statements, I do put the grant and the portion that was forgiven on the PPP on your profit and loss as other income. That's simply so that your tax preparer can know that you have those, right? And we named it very clearly that they are grants. So your accountant should be able to tell that those are not inclusive in your income tax to declare your income tax. But for the PPP, for example, until the amount is forgiven, it is a long-term liability on your balance sheet. Same with the EIDL loan. It is a long-term liability on your balance sheet, so you don't see those items on your profit and loss or your income statement. That's correct. Right? I consult with you before I did that.
No, that's a good way to do it. It really is a good way to do it.
Thank you. So I think that one of the question is for the somebody received an EIDL grant, but was denied the loan, and how should the CPA handle the business tax return? I think that Mel already answered this question, that if you got an EIDL grant, fantastic. There's no taxes. You don't even have to report it. It's all good news there. But you will see, like I say, you will see it on your income statement when we prepare it for you. And let me see. Okay, so there is a question specifically for the EIDL loan that about keeping receipts for the EIDL loans. I know that when it comes to Paycheck Protection Program, you do need to substantiate how you spend the money so that you can apply for forgiveness. The EIDL loan is a loan, so I can imagine the requirement isn't as strict, and as long as you make the payment, I don't think they care. But I want to hear that's Lisa's philosophy. But I like to hear what Mel thinks that legally you need to do.
Yeah, I think overall you're right, Lisa. The thing about receipts, and this has changed in the last couple of years because I've been representing people at IRS audits for a long time. And most, up to a couple of years ago, we could take in the credit card statement and say, this is Staples, bought office supplies. Well, now we show them the credit card statement and they say they want to see a receipt. So I think it's important that you keep receipts no matter what, okay? If you think it's, this comes back to, how you interact with the CPA when you show up at the tax interview. If you don't have a receipt, it's going to be difficult to write it off. If you have too many receipts, that's okay because it doesn't hurt you. If you don't have enough, it does hurt you. So I'm in favor of keeping all receipts, and you can do it very easily. I mean, you can get one of those red accordion files at Staples or Office Max or one of them that has the alphabet on it. And when you get a receipt, you just put it in the slot that relates to the name of the vendor. But receipts are really important. Yeah, Lisa, you have to have detailed receipts and schedules for the PPP forgiveness. For EIDL, you have to have the receipts, but it doesn't. Those two are not related. Okay?
Yeah. So you don't want receipts in a shoebox.
I'm sorry.
You don't want the clients to bring a shoebox of receipts to you. You want them to itemize it into different categories.
Well, yeah. If they don't bring them a statement like you prepare, I give them the option. Okay, I can do that for $2,500, or they can have you do that. So, not a good idea.
A lot less, people.
Yeah, a lot less.
A lot less.
Not a good idea.
Not a good idea.
Yeah.
So the nice thing.
I'm being facetious, Lisa, because I don't do that. Okay, if they bring me in something, I send them away and say, look, this is how you do it, but this is what I need.
Yes, and you, that's one thing I do need to say is that you have a lot of heart. When it comes to empathizing with small business, and we've had conversation like this when we look at a client tax returns and you're like, oh my God, how could they charge this client this much? I mean, how much better can they do this return? So I think that is, I really love the fact that you're very fair, and all of the clients that I've referred to you, they all love you. And I know some of them are attending today, so they can even vouch for you later.
Lisa, one of our participants was asking if you could repeat your point about PPP and payroll. The sound cut out at the end of your point. It was a really good one, though.
So for me or Lisa?
It was for Lisa. She was talking about PPP.
I think that, I'm not sure which one, but one of the things I talked about is there are businesses who were not making money this year because they're a startup, and they put themselves on payroll because they think that they need to have that because of the PPP, or because they think they need to put the company needs to have payroll. What we're saying is you don't need to put yourself on payroll, even if you have a subchapter S, until your business makes money. Doesn't make any sense to pay yourself and pay payroll taxes when your business is making a loss. In terms of the PPP, there are, it's already, now it's late, right? They don't give out the loans for the PPP loan anymore. But during the time when they did, a company that didn't have payroll, the sole proprietor, can still get PPP money by the IRS look at, or the bank, the lender look at the amount that you earn on your Schedule C, and they figure out your PPP loan amount. So I hope that's answered your question. Anything else, Victor?
Not yet.
Okay, good. So one other question is, what is something you absolutely should do before meeting with a CPA?
Yeah, yeah. Well, typically, an organized CPA, before you meet with them, will send you out a tax organizer.
Mhm.
And that's it's intimidating to some people because it's designed to cover every possible aspect of taxes. Okay. But if you get a tax organizer, it's designed to just jog your memory of things that have happened during the year that you forgot,
Mhm.
so that you can get every single tax deduction to which you're entitled.
Mhm.
And so the two things I would suggest: fill out the tax organizer and organize all the other documents you have, all the government documents, W-2, 1098 for the interest, 1099 for non-employee compensation, those kind of things. Just have it all organized and ready to go, because the more time you spend with the CPA, the more it's going to cost you. Okay?
Yeah, and
It's just that
thank you.
simple.
Thank you for the warning. And for my clients, this is why we do bookkeeping daily, right? So that you don't miss, you don't forget about something. If your book is always up to date, you have an expense that you pay with cash, you can just take a picture of the receipt and send it to us, and we'll add that in. If you think you are going to remember to tell your CPA at the end of the year about that one expense that you pay with cash, you are a much better person than I could ever be, because I know for sure I could never do that. So daily bookkeeping is important for that reason. Is keep you up to date, and we make sure that all your deductions are accounted for. And then, yeah. And like Mel say, I'm a lot cheaper than CPA. So some of the best practices that I like to bring up to is, I know we talk about not commingling funds. We talk about one of the things that I feel at this time of the year that people should really have a good handle on is their contractors, right? I don't know if we want to talk about this, but it is important because, small business, a lot of time, you're not able to hire a full staff to support your business, and therefore you work with other companies as subcontractors. And I know Mel can talk a little bit more about the AB5 that has passed, but what are some of the things that business need to know or worry about in regards to 1099?
Yeah. I do several EDD audits a year, and they are specifically looking for companies that pay their employees as contractors. And there are severe fines that are associated with that. And with the passing of AB5, it's really hard to hire a subcontractor that doesn't have their own business. And even if you really want to be conservative, even if you hire another sole proprietor. Now, I would argue, if I went into an audit, that this is a separate business. They have their own letterhead, they have their own website, they have their own business cards. This isn't that he's been in business for 10 years. It's an established business. Anytime you pay a subcontractor that's not a corporation, you are running the risk of having the EDD get upset with you. That is costly. So yeah,
they want their employment tax, right? I mean, California unemployment insurance is so underwater that they really want to make sure that you're funding that program. So, one of the tax that you pay for your employee is state unemployment insurance. And California rate for that is really high, but unfortunately, that is something that that's why it triggers their audits a lot, and they're so mean about it because they want their money.
Yeah, the disability, and also the the powers that be, when this was enacted, thought that since the California tax was not being withheld, their income tax, that they weren't getting their fair share. Now, there's a much easier way to handle this whole thing, and that's just have California have a 1% self-employment tax. Okay, much easier way to handle it, but it is what it is, and you just have to be very, very careful. You know, they're looking for abuse, like in anything. So if you're forced to do that, just don't abuse it.
Yes, and one thing I always recommend my clients to do is don't pay them until they provide you the W-9. People are really motivated to provide you the W-9 if you're withholding their payment. But once you pay them, it is so hard to get that information from them, right? So if you haven't done it all year, now is the time to do it, because January is too late.
Yeah, that's so true. And also taking it back to the federal, if you don't withhold and all those things, and they determine a subcontractor that's an employee, then you are responsible for their payroll taxes.
Yes. Yep. So they gross up, people, right? Yep. So whatever, let's say you pay a subcontractor $100, and they determine that that subcontractor is an employee, they're gonna gross up that paycheck. So instead of your cost to that guy was just $100, now it's like $120, for example, was what you're supposed to have paid them. And then all the taxes, both sides, the employee side, the employer side, you pay for it all. So not to scare you, but it's really time to take a look at it and let's strategize on how we can tackle this, because it's not going away, especially if you have business in California. It's not going away. So is there any questions out there that I should address? Let's see how we do on time. Okay, good. So we still have about 10 minutes. And one of the questions that, so just so everybody is aware, I don't know if you have received some of my email, but the Share and Learn series for the tax season. So today we're kicking off with Ask a CPA, and next week we have a same time meeting with a financial planner, because my thought is you figure out your tax positions, and then you can strategize with the CPA, and then perhaps put up a plan to reduce your tax liability. I was going to say shelter, but probably not a good term. So reduce your tax liability. So next week we'll hear from a financial planner. But today, could you talk to us a little bit about qualified business retirement account, qualified business income?
Oh, sure.
Yeah.
You know, that's one of the terrific benefits of the Tax Act of December of 17. And what it is basically for people like us, small and medium-sized businesses, we don't have to pay income tax on 20% of our earnings. And I had an interesting case. I have a client in Tennessee, and she had a tax preparer prepare her partnership return, but she thought it'd be a good idea if she prepared her own return. And so she asked me, and I discovered this by accident, but she asked me to take a look at whether or not the partnership return was prepared properly and whether it was reflected on her personal return properly. Well, I discovered that, yes, the partnership return was prepared properly, but she didn't take advantage of the QBI. And so I refiled that return and got her a refund of $8,000. So it's a very beneficial, important deduction for self-employed people. And it's huge, not to be overlooked.
Wonderful. Thank you for sharing that. One of the other items that I have gotten asked often and lately is Section 179 regarding car vehicle deductions. there's a lot of misinformation out there about that, I feel. Can you shed some light on that for us?
Yeah, that's an interesting question. That would probably take the whole rest of the hour.
Oh,
But
okay.
in a nutshell, Section 179 allows you to write off a capital expense in the year that you purchase it. So it used to be that if you bought, I don't know, a desk, you paid $1,000 for a desk, you had to depreciate it over a period of time. Well, with Section 179, and there are some limits, but most of us don't get those limits. I mean, buying $2.2 million of capital expenses and things like that. But now we buy a desk. We can go out and buy a desk on December 30th, pay for it, get it in the office, and write the whole thing off that year, entire amount. So yeah, Section 179 is really a great deduction. You have to be a little bit careful of how it's used, though. If you are in a loss situation, you don't have a real benefit. You didn't used to have a real benefit of having that loss, be greater at the end of the year. And now we come down to the individual tax situation. What happened in the last 3 years? Okay, did they have income on which they paid taxes? If they didn't, then 179 is probably not the way to go. And you set it up. There's another, I'm not going to complicate it, but that's basically it. You can write off capital assets, which usually are depreciated over a period of time in the year that you purchase them. A tremendous advantage.
Wonderful. And so I know that, 2020 is a year that for many of us, we just want it to be over, right? But there are businesses or industry that thrives, for this year because of the industry that they're in. So if your business is doing well and you're looking for ways to maybe reduce your tax liability this year, maybe consider investing in the business for capital investments. Is just what Mel had just talked about, and you can write the whole thing off. One thing that come up often, and I know you don't have to go in too much into detail, is people applying Section 179 to car, right? So they have the business buy the car, and so how can you give us some info on that? I get different messages from different accountants.
Yeah, that unfortunately is not a black and white situation, and here's why. Normally, a business car is only a portion of the purchase. So you pay 30 grand for the car, but you only use it 67% for business. That's the only amount that is deductible. But then there are certain rules for new cars, used cars, cars over 4,000 pounds, so-called luxury vehicles, and they're all different, okay? So, and what complicates it even further is that if you run up a huge number of miles, like I have a client that drives 60,000 miles a year. He's an appraiser and he goes all over the universe. In his case, he's better off taking the mileage deduction. So in that case, then that eliminates the advantage of the 179 for cars. That is that's a little more involved. That you get right down to it, but it's something that you should be talking to your CPA about for sure.
Wonderful. Thank you, Mel. So to recap that, when we do your book and you tell us about a new purchase or a new lease of a car that you have, we will put it on your balance sheet, okay? Because if you had paid for it or financed it through your business, we'll put it on there. But the point is we put it there so that you can have that discussion with the CPA, right? So when you sit down and do your tax planning, it's there, you don't forget about it. And that's why we add them in to your book. So as much as we can, we feel that our job is to bring the data together there on the financial statement so that you can have the discussion with your tax filer about it. what we expect back though, clients, is when the CPA file your tax return and make changes to that report as to they have to move it somewhere else. Maybe something was on a liability, they want to move over to an expense. Bring that back to us, please, so that we can adjust your book accordingly, because we want to make sure that it matches what's on your tax return. So with that said, I know our time is, we have 2 more minutes. Is there any last advice that you have for all of us, Mel?
Well, Lisa, I know this is going to sound like an advertisement, but I really, in my heart, I believe this a lot, okay? I really feel that it's not productive for most people to do their own bookkeeping. Because when you think about it, you can hire Lisa to do it at a reasonable cost versus you struggling with it and maybe getting it right and maybe not getting it right. And I've seen a lot of cases where people do their own bookkeeping. Oh, I've just got some awful cases where they do their own bookkeeping and they end up overpaying their taxes, or in some cases underpaying, and the IRS shows up at their door claiming their firstborn. So really seriously consider Lisa. I've worked with her for a long time. I know her people, and she does a great job. Okay.
Thank you. Thank you, Mel. And I did not have to pay him for that at all. So this one's on the house, right, Mel? Thank you. Thank you so much, everybody, for joining us, our little SmartBean community. I am going, like I said, we're going to have another one next week from the financial advisors, and then we will have 2 more in December. We are going to continue to have this Shares and Learn session all throughout tax season with relatable topics. Beginning of the year, I'm going to focus more on, business planning and budgeting and things like that. So thank you so much for being our first guest. I really have enjoyed, I've always enjoyed talking to you, Mel, because I always learn so much from you. And thank you, everybody, for making time for us. And if you have any questions, please feel free to reach out to me. And actually, I would like to also just share really quickly Mel's information on the screen so that you can contact him. Let's see, did I do this way? And here you go.
Thanks for everybody. And those are really very good questions, very thoughtful.
Thank you. So Mel's information's on the screen, but if you need to get a hold of him, for sure, reach out to me, reach out to Victor and Candria, and everybody have a wonderful Thursday. Thank you for your time.
Yeah. Have a great day, everybody.
Bye.
Thank you, Lisa. Okay.
Thank you, Mel.
Bye.
Bye.